When the stock market crashes, it seems as if enormous amounts of money disappear in a single moment. Headlines claim that billions of dollars have been wiped out, and people begin to wonder where all that wealth actually went. The truth is that money does not vanish, it moves. It changes hands, ownership, and perception. To understand where it goes, one must first understand what the stock market truly represents. The stock market is not a physical vault filled with cash. It is a marketplace where investors trade ownership shares in real companies. When you buy a share, you are purchasing a piece of ownership in that business, its assets, its potential profits, and its future growth. The price of a share is not fixed by the company itself. It is determined by what buyers are willing to pay and what sellers are willing to accept at any given moment. Every market price is built on perception. If a company announces good earnings, optimism rises and more people want to buy its stock. The price increases. If uncertainty or fear enters the market, investors sell and prices drop. The stock price therefore reflects collective belief about future profitability, rather than actual cash stored somewhere. Imagine a company called Greenwave that manufactures energy-efficient products. Today, its share trades at $100. If tomorrow investors believe the company's growth will slow, they may sell, causing the price to fall to $80. That $20 drop does not mean the company lost that cash. Its machines, offices, and employees are still there. What changed is the opinion of the market about its future value. When the entire stock market falls, this process happens on a massive scale. Thousands of investors revise their expectations at the same time. The combined price of all listed companies, known as total market capitalization, shrinks. But it is not that cash is destroyed. It is simply that fewer people are willing to pay previous prices. The fall in stock value represents a change in what investors think those companies are worth, not a physical loss of money. Consider what happens when one investor sells a stock for a lower price. That investor experiences a personal loss because they receive less money than they initially paid. But the buyer of that same stock acquires it at a lower cost. The ownership changes hands. The company itself still exists. The market has not removed money. It has redistributed it. In a broader sense, when stock markets decline, investors often move their funds into safer areas such as savings, short-term deposits, or tangible assets. The money flows from one asset class to another. This movement of capital gives the impression that money is disappearing, but in reality, it is shifting positions. Another way to look at this is through the concept of paper wealth. Market prices represent what people are willing to pay at that instant. If you own a share and the market price drops, your portfolio value appears smaller. But until you sell, that loss remains unrealized. It exists only on paper. If the price later recovers, the paper loss disappears as quickly as it appeared. The only time a loss becomes real is when a sale takes place below the purchase price. This difference between realized and unrealized loss is central to understanding stock market behavior. Many investors panic when they see falling numbers, assuming the market has destroyed their wealth. In truth, the companies and assets that underpin those shares still exist. The stock market merely reflects changing opinions about them. Let us take a simple analogy. Suppose someone owns a house worth $300,000. If property prices in the neighborhood fall to $270,000, has $30,000 vanished? No, the house remains the same, providing the same shelter and utility. The price change only matters if the owner decides to sell at that lower value. Stocks function in the same way. Crashes occur when many investors simultaneously decide that future profits may be lower or risks higher. This sudden change in confidence leads to a sharp drop in prices. It is not a destruction of real wealth. It is a correction in collective expectations. The total productive capacity of the economy, the factories, services, and labor continues to exist. Only their perceived market value adjusts. These price movements are part of how markets find balance. When optimism pushes prices to high compared to actual earnings, a correction brings them back in line with reality. This process may feel painful for investors in the short term, but it helps prevent long-term imbalances. From a rational investing perspective, the most important insight is that money in the stock market is a representation of ownership, not a pile of cash that can disappear. When shares fall, wealth transfers from one group of investors to another based on timing and decisions. Those who sell during a downturn realize their losses, while those who buy at discounted prices and hold for recovery may gain later. The idea that billions of dollars are lost is therefore a misunderstanding. What is actually lost is confidence, not cash. the market as a whole continues to function, and most of the actual money remains within the financial system, redistributed across different accounts and assets. Another important point is that markets are emotional systems, driven by human behavior. Fear and greed amplify movements in both directions. During strong rallies, prices may rise far above the true value of companies. During crashes, fear pushes prices below fair value. In both cases, perception, not physical money, moves prices. This is why long-term, value-based investing tends to outperform short-term speculation. Investors who focus on real business fundamentals, revenues, assets, and stability understand that market volatility is temporary. They see a crash not as destruction, but as an opportunity to acquire ownership at fairer prices. Ultimately, when the stock market falls, money does not vanish into the air. It changes form and ownership. Some investors exit at a loss, others enter with hope, and capital flows to new hands. The underlying economy remains, waiting for confidence to rebuild. Understanding this simple truth helps investors respond calmly rather than emotionally, recognizing that the market's value is a mirror of collective opinion, not an absolute measure of wealth. When a market crash occurs, the initial reaction is often emotional rather than rational. Fear takes control, and investors rush to sell their holdings. But after the panic fades, something interesting happens. The market begins to rebuild itself. Understanding how this recovery process works helps explain where the lost money eventually goes and why financial systems continue to function even after large declines. A crash represents a sudden drop in confidence. Prices fall because the collective belief in future profits weakens. However, just as confidence can disappear quickly, it can also return. Once stability and clarity begin to emerge, buyers come back into the market. The same shares that were sold at panic prices are purchased by new investors who see opportunity. This transfer of ownership marks the beginning of recovery. The flow of money during this process follows a predictable pattern. In the early stages of a downturn, cash moves out of riskier assets and into safer ones such as savings, government securities, or short-term deposits. Institutions and individuals hold their funds until uncertainty decreases. As soon as stability returns, they begin reallocating their capital back into productive investments. Therefore, the money never vanishes, it pauses, waits, and then re-enters the system in new directions. It is also essential to remember that the stock market reflects expectations, not the real economy itself. The physical world, factories, businesses, transportation networks, and technologies does not stop existing during a crash. It continues to operate. The workers continue to work, products continue to sell, and services continue to function. When investor sentiment improves, market prices rise to match the underlying reality again. The recovery phase begins when investors start noticing that valuations are too low compared to what companies truly produce. Long-term investors, who study businesses rather than emotions, begin buying. This activity gradually stabilizes prices. Over time, confidence spreads, volume increases, and the market finds a new balance. In this way, crashes and recoveries form part of the same cycle, the rebalancing of perception and reality. Let us examine this with a simple example. Suppose that during a market boom, a technology company's share price reaches to $100. Even though its actual earnings support only $150, the overvaluation reflects excessive optimism. When reality catches up, the price falls sharply. Many investors panic and sell at a loss. But a new group of investors sees that at $120, the company is once again reasonably priced. They buy. As the business continues to perform, the stock slowly rises again. No wealth has been destroyed. It is only shifted among investors and adjusted to reflect genuine value. This concept is fundamental to understanding capital markets. Prices are never static because opinions, knowledge, and global events continuously evolve. What looks like destruction is often reorganization. Money that left one asset reappears in another, perhaps in bonds, commodities, or real estate. Later, it may flow back to stocks. The financial system is a network of exchanges, not a single reservoir that empties and fills. Another way to view it is through liquidity. When prices fall, some investors need cash urgently, so they sell at lower prices. The buyers who provide that liquidity are effectively exchanging their cash for ownership at discounted levels. As time passes and markets stabilize, those buyers may benefit from appreciation. The earlier sellers have transferred value potential to the new holders. In this sense, the so-called lost money simply changes form and ownership. Economic downturns following market crashes can slow spending and reduce profits temporarily. However, most recoveries begin when central and corporate strategies focus on rebuilding confidence. Companies improve efficiency, investors become more selective, and consumers adapt. The resulting growth creates new value that gradually replaces the perceived losses. The psychological element plays a massive role in this process. Markets are human systems built on behavior and sentiment. Fear magnifies losses. Optimism amplifies gains. This cyclical pattern means that even large declines are not permanent. Over long periods, markets have always recovered from crashes because economies keep producing goods, services, and innovations that hold real value. It is also helpful to distinguish between speculative losses and real losses. Speculative losses occur when inflated expectations collapse. These are temporary corrections that bring prices closer to reality. Real losses occur only when businesses fail, assets become unusable, or capital is permanently withdrawn from productive activity. Most stock market crashes are dominated by the first type. That is why history shows that markets, given time, eventually regain their previous levels and even exceed them. Consider the global financial crisis of 2008. Stock indices around the world fell sharply, wiping out trillions in apparent wealth. Yet within a few years, the same indices recovered and reached new highs. The world's productive capacity had not disappeared. It had simply been mispriced. Once investors realized that, confidence returned and capital flowed back into equities. This understanding shapes the behavior of disciplined investors. They know that market value is a reflection of collective emotion, not an exact measure of real worth. During crashes, they focus on quality businesses with strong fundamentals, sustainable models, and tangible assets. Rather than panic selling, they may even add to their holdings when prices are unjustly low. Their patience allows them to benefit when the market eventually corrects upward. Short-term traders often experience the opposite, driven by emotion. They sell during fear and buy during euphoria, transferring wealth to those who act rationally. The pattern repeats every cycle. Recognizing this human behavior is key to maintaining perspective during market volatility. The idea that money disappears also comes from misunderstanding. How financial accounting works: when a company's share price declines, its total market capitalization falls. But the company's balance sheet remains the same until real operations are affected. The market's estimate of its worth is changed, not its actual cash holdings. Only if the company's earnings decline or it goes out of business would there be a real reduction in wealth. Even then, the money itself does not vanish. It may move to creditors, employees, suppliers, or other investors who now hold assets or claims in the economy. Every financial transaction has two sides. One loses, another gains. The overall amount of money in circulation remains largely constant, though its distribution shifts. It is also worth noting that governments and institutions often play a stabilizing role. After crashes, policy measures such as adjusting interest rates, improving financial regulations, or providing liquidity to the system help restore confidence. These interventions do not create or destroy wealth. They guide the flow of capital towards stability. The market responds, adjusts expectations, and begins a new growth phase. From a broader perspective, crashes serve a cleansing purpose in financial systems. They expose weak companies, remove unsustainable valuations, and reward stronger, more transparent businesses. This renewal process is what allows markets to evolve. It is not pleasant for those caught in the downturn, but it ensures long-term health by realigning price with reality. For individual investors, the key lessons are clarity, patience, and perspective. Understanding that money in markets moves rather than disappears helps reduce fear. Maintaining diversified investments and avoiding overexposure to speculation protects against emotional decision-making. Those who treat investing as ownership in real businesses, rather than a quick trade, handle volatility more calmly. Risk management is also essential. Holding emergency savings, setting realistic goals, and reviewing portfolios periodically provides stability during turbulent times. The goal of investing is not to avoid losses entirely, but to manage them wisely and stay positioned for eventual recovery. In conclusion, when the stock market crashes, the so-called lost money does not disappear into a void. It moves from one place to another, changes ownership, or transforms into different assets. Some investors lose confidence and sell, others see opportunity and buy. The total wealth of society remains grounded in its ability to produce, trade, and create. Crashes and recoveries are two sides of the same cycle, reminding investors that markets measure sentiment, not the true foundation of value. By focusing on real businesses, practicing discipline, and understanding that perception drives prices, investors can remain calm through downturns. The market's waves of fear and optimism are temporary, but the flow of money continues, reshaping ownership rather than erasing it. The lesson is clear. Value does not vanish, it redistributes, recalibrates, and eventually rebuilds. Finally, a long-term view always outperforms short-term reaction. Every major crash in history, from the Great Depression to the modern era, has been followed by recovery and new growth. Human innovation, entrepreneurship, and demand never stop. Markets reflect these forces over time. Prices may fluctuate, but value continues to be created through productivity and progress. In conclusion, when the stock market crashes, the so-called lost money does not disappear into a void. It moves from one place to another, changes ownership, or transforms into different assets. Some investors lose confidence and sell, others see opportunity and buy. The total wealth of society remains grounded in its ability to produce, trade, and create. Crashes and recoveries are two sides of the same cycle, reminding investors that markets measure sentiment, not the true foundation of value. By focusing on real businesses, practicing discipline, and understanding that perception drives prices, investors can remain calm through downturns. The market's waves of fear and optimism are temporary, but the flow of money continues, reshaping ownership rather than erasing it. The lesson is clear. Value does not vanish, it redistributes, recalibrates, and eventually rebuilds.